with Denver Private Wealth Management, coming to you today with our quarter three commentary for 2021 surrounding the debt ceiling conundrum. Now, the debt ceiling is something that has been in the news a lot lately, and this graph just goes to show that the Google searches for the term debt ceiling have been spiking lately as it's been coming more and more into focus within the news and in mainstream media. Now, the debt ceiling, I think it's really important to remember, is something like increasing the limit on your credit card. So increasing your credit card limit from 10,000 to 15,000 is really what Congress is debating on. The difference being, though, is that most people think that debt ceiling is forward-looking, as if you're increasing the credit card limit so you can spend more money in the future. However, the debt ceiling is actually looking backwards in the rearview mirror. What we mean by that is Congress is looking to increase the debt ceiling from 10,000 to 15,000 because they've already agreed and committed to paying bills. And if they aren't able to increase that credit limit, they won't be able to pay bills and they're going to default on those payments. Taking it back to an example more for the everyday person, if you miss a couple mortgage payments, you don't want your credit score to go from 830 to 700. And that's really what's going on right now. The U.S. government and the debt that they issue out is looked at as almost safe currency because it's always paid, and it's looked at as essentially a safe return in terms of the U.S. Treasuries. Now, if we aren't able to increase the debt ceiling and our obligations are downgraded from a bond perspective, that's going to be incredibly bad for the U.S. economy and the stock market as a whole. And it's also going to make it harder for us to pay our obligations going forward because there's going to be a higher interest rate associated because it is not quite as guaranteed that we will be paying those payments. So, looking back on time, you'll notice that while this seems like a big deal today, the debt ceiling has actually been discussed since 1960. Has actually been raised 78 times during that time frame, and that's actually across both presidencies. So while this feels like a big deal today, you'll notice that this has happened many, many times before. Both sides use it as somewhat of a political football in order to get somewhat of a political edge. But at the end of the day, both sides have such a vested interest in seeing that debt ceiling raised in order to pay things that Congress has already committed to paying, that there's nothing that's really going to keep from that debt ceiling being increased one way or another. There might be some stress and some volatility along the way, but the obligations of the U.S. government will be paid. You'll notice here that over time, the number of days without a budget and the debt ceiling or a government shutdown has increased over time. So back in the day, you're only looking at 1 to 3 days, we'll call it, in terms of government shutdown before that debt ceiling is increased and the U.S. government pays their obligations and the government is no longer quote unquote shut down. However, over the last 1 to 2 decades, we've seen an increase when it comes to how long the government is quote unquote shut down. And but that being said, while that's been more and more the norm over the last few decades, on average, you're looking at about 7 days or a median of 3 days of government shutdown or without any type of budget authority. Going back to that, there's been some volatility in the market because it's something that people are worried about. Stock market's been doing very well lately, and so something had to be on the horizon that got people concerned, which is very understandable. So it's worth looking, to past events in order to see what happens during a shutdown with the actual U.S. stock market. And you'll notice that actually, for the most part, not that much occurs. There hasn't been that much in terms of, quote unquote, a crisis or a stock market plunge occurring. The one time it did happen, going back, would be when that U.S. credit, those U.S. bonds were downgraded, which once again is the worst thing that could happen. And so that's the one time we've really seen a strong negative return, and something that Congress definitely has a vested interest in making sure doesn't occur in the future. So come December, obviously this was kind of, the can was kicked down the road a little bit. So come December, when this is voted on and a debt ceiling comes to a head and has to be passed, definitely expect some volatility and some nervousness by all people. But once again, everyone has a vested interest in raising that debt ceiling, not for future purchases, because we're raising the debt ceiling for things that the U.S. and Congress and the government in general has already committed to paying. So I hope this was incredibly informative. I hope this was helpful. As always, at Denver Private Wealth Management, we are doing our best to serve our clients' needs and provide clarity and context wherever we can. So please feel free to reach out and ask how this may affect your individual portfolio. We look forward to talking to you soon. Thank you.